Let's get one thing straight. You aren't investing for fun. You're not doing it because some finance guru on TV told you to. Why am I investing? The answer isn't just to make more money. That's lazy. You invest to achieve specific goals. Are you trying to save up for a down payment on a house? Are you planning for a comfortable retirement where you don't have to eat cat food? Do you want to pay for your kids' college education without saddling them with debt? These are real, tangible goals. Put a number and a date on them. That transforms a vague dream into a concrete financial goal. Dream: I want to retire someday. Goal: I want 2 million saved by 65. A timeline dictates your entire strategy. Now, the invisible enemy that's eating your money alive: inflation. It's the reason a movie ticket that cost your parents a couple of bucks now costs you 15. Money sitting in a checking account is losing value every single day. Say your dream college education for your child costs rupee 50 lakh today. If we assume a pretty standard inflation rate of 8% per year, guess what that same education will cost in just 10 years? It will be about rupee 1 crore 8 lakh. People use the words saving and investing interchangeably, but they are completely different animals. Stop doing that. Saving is for short-term goals, typically anything within the next 5 years. This is money you absolutely cannot afford to lose. It's your emergency fund, your down payment for a house you plan to buy soon, cash for a wedding next year. The primary goal of saving is security. You put this money in a high-yield savings account where it's safe, accessible, and earns a tiny bit of interest. The returns are pathetic, but that's not the point. The point is that the money will be there when you need it. Investing, on the other hand, is for your long-term goals. We're talking 5 years, 10 years, or even decades into the future. This is the money for your retirement, for your kids' college fund, or for building serious, long-term wealth. The goal of investing is growth. You are intentionally taking on a calculated amount of risk with the expectation of earning a much higher return over time. You absolutely must have your savings in place before you even think about investing. Pay off high-interest debt, build your emergency fund first. So when you look at a place to put your money, what should you even look at? Most people just ask, how much will I make? Which is the wrong question to start with. You need to look at 3 key factors. The first is safety. How likely is it that you could lose your original investment? The second is liquidity. How quickly and easily can you turn this investment back into cash without taking a big loss? A house is not very liquid. A stock is very liquid. The third, and only then, is returns. What is the potential for this investment to grow in value or pay you an income? There's no perfect investment that gives you maximum safety, maximum liquidity, and maximum returns all at once. It doesn't exist. If someone tries to sell you on one, they are lying. You will always be making a trade-off. High-return investments typically come with lower safety, more risk. Super safe investments usually offer terrible returns. Find the right balance that aligns with your specific financial goal and its timeline. For a short-term goal, you prioritize safety and liquidity. For a long-term goal, you can afford to prioritize returns. Let's demystify the so-called asset classes. These are just fancy buckets for different types of investments. Real estate is property like land and buildings. It takes a lot of capital and is notoriously slow to sell. Gold is often used as a defense against economic uncertainty. Section 4. The brain game. How your mind plays tricks on you. Investing isn't just about numbers and charts. It's about psychology. Your brain is hardwired with biases that can cause you to make dumb decisions with your money. Fear and greed are powerful emotions that can derail even the most carefully laid plans. Recognizing these behavioral biases is the first step to conquering them. Herd mentality. When a stock is soaring and everyone is buying, you feel the need to jump in. When everyone is panic selling, you feel the urge to sell too. This is a recipe for buying high and selling low. Studies show the pain of losing money is twice as powerful as the pleasure of gaining an equal amount. This leads people to hold on to losing investments for way too long. hoping they'll break even. You think you're smarter than the market and can pick winning stocks. You can't, and neither can 99% of the so-called experts. We invest in what we know, like the company we work for. That's a terrible idea. It concentrates risk instead of diversifying it. We give too much weight to recent events. Market up for years? We assume it goes up forever. Market crash? We assume it never recovers. We forget long-term historical data. We seek info that supports our beliefs and ignore contradictions. You just bought a stock and suddenly find 10 glowing articles. It feels good, but it blinds you to risks. The best defense is a good offense, a simple, automated investment plan, and sticking to it. Section 5. The Master Plan. Building your investment machine. This all comes together in your personal investment plan. The first step is risk profiling, a structured way to figure out what kind of investor you are. It has 3 parts. First, your need to take risk, set by your goals. If you have ambitious goals and a long timeline, you have a higher need to take risk for better returns. Second, your ability to take risk. This is your financial situation, income, savings, job stability, timeline. A 25-year-old with a stable job has a higher ability to take risk. A 60-year-old nearing retirement has lower ability. Final piece, your willingness to take risk. If your portfolio dropped 20% in a month, would you panic and sell, or see it as a buying opportunity? Be brutally honest. A good plan balances need, ability, willingness. If willingness is low, but need is high, adjust your goals, or get comfortable with market swings. Once you know your risk profile, decide your asset allocation. It's the cornerstone of your strategy. Example for long-term investors. A 60-40 split, 60% equity, 40% fixed income. That's your strategic allocation. You can make small tactical allocations, but most should stick to the plan. Markets move. Your 60-40 can drift. If stocks have a great year, it might become 70-30. You're taking more risk. Rebalancing brings it back to target. It's disciplined, automatic. Sell high, buy low.